All right, Jeff, morning. How are you?
Morning, how's it going? Good.
Doing really well. So today we want to talk about one of the hot topics in the real estate industry right now. And what that is how are interest rates affecting home buyers? Is it affecting them at all? Is it not? Is it a big deal? Is it not a big deal? It's all over the media. We know that. And people paint it in to be this horrible thing. And if you think about it, interest rates have gone up. So interest rates right now, depending on credit score, down payments, different variations, different things like that, interest rates could hover anywhere from the low fives to the high fives. So 5.35. I think the average right now is closer to 5.8% for a 30-year conventional loan. And that's putting 20% down and a decent credit score in the 700. So close to 6%. Interest rates in December were in the threes, low 3%. So let's just say we've gained almost a double in interest rate, going from essentially 3% to close to 6%. And what do we know from that, Jeff? We know that for every 1% in interest rate rises, a home buyer loses 10% buying power. Correct? So if I'm looking at a 500K house, now all of a sudden I've lost, 30% buying power? I've lost $150,000 in purchasing power that I had in December that I don't have now in May, just because my rates tripled.
Exactly. And the most important thing too is, like, for anybody that bought a house even up to a year ago when rates were definitely in the threes. I mean, I remember some people were even lucky enough to be able to get into the twos, like 2.9, which is almost unheard of because the interest rates are always tied to inflation rates. And so, on the historic side of things, even a 5% interest rate, somewhere in the fives, is still very good. It's still a low interest rate when compared to the grand scheme of things. We've just been very spoiled these last couple of years of being able to get 3% interest rates and 4% interest rates. And the media's got to make a big deal about everything. So of course, when you go from 3% back up to 5%, like, that's the news story of the day. And I think the important thing is, like, not necessarily the number of the interest rate itself. It's what does it mean? What does it affect? And so to your point, it affects purchasing power. And for purchasing power, that affects affordability. And especially because, too, if you're looking at something that's at a 3% rate versus a 5% rate, when it comes to mortgage loans especially, I mean, you're talking hundreds of dollars of difference in your monthly payment. And that's where everybody really feels it. That's where it matters. That's what we talk about with our buyers especially, is what is the monthly payment? Are you comfortable with the monthly payment? Because that's what you live with month over month, year over year, and that's what you're locking in. And so that still is key, is, are you comfortable with the monthly payment? Because if you are, even at 5.5% interest rate, it's still a great time to buy a house. And to me, it is always a great time to be buying, because there are deals to be had everywhere. As long as you're looking and you're looking hard, you will find them, no matter what the interest rate is. It could be 20%, and you can still find good deals based off of what that is. That's why people use hard money lenders, and they're at 8, 9, 10, 11, 12% interest rates. And it's because it's short term and they know that they can refinance out. And it's the same concept with the 30 years, that it's all tied to inflation. If the inflation rate's high, interest rates go up. And that's exactly what's been happening, especially in April. Interest rates were, the inflation rate in April was 8.3%. So if you're telling me that I can still lock into an interest rate and the 5 percentage points, but inflation's at 8.3%, then I'll lock in at 5% every day of the week, because I know that I'm beating inflation by doing that. And that's the key, is that everyone loves to talk about the interest rate, but when you break it down, it's all based on what does inflation look like. And if inflation continues to go up, the interest rates are going to continue to go up. And so that's the biggest thing on my mind, is when I'm looking at interest rates, don't let the number scare you. If you're in the market to buy a home, especially if you're a first-time home buyer, like, the market's still great to be buying a house, because your interest rates are still in the 5 percentage points. Like, yes, you're not in the 3 anymore, but guess what? If it does go back down to 3 or it does go back down to 4, you have the ability to refinance as long as you bought a house. If you have never bought a house and you still don't buy a house, no matter what the interest rate is, it doesn't matter, because you can't refinance.
No, that's a great point that people don't think about. If rates did drop, you can refinance and lock into a lower interest rate. So that's always an option. The other thing too, when I got in the industry in 05, at the end of 05, call it 06, rates were 6.5, sometimes even close to 7%. And 6% was considered a very good interest rate. Just as you mentioned, we've gotten spoiled with the 2% and the 3%. And so 6% historically is still a very good interest rate. And that's what people tend to forget. What also happens is that we talk about this a lot within our team and our organization, is that the majority of the public on residential real estate, people are buying that house, not necessarily for an investment. They might think they are, but ultimately 90% of home buyers are buying it out of emotion. They're buying it because they want a bigger house for their family. They want a better school district. They want a bigger yard. They want a finished basement. They want a pool. They want something. They want a home. They're buying a home. They're not buying it strictly based on investment. If that were the case, people wouldn't buy houses that they buy. It would solely be numbers driven. I was having a conversation with a lady the other night. She said, "Oh, we're not worried about interest rates. We bought a house when it was 12.5%. Interest rates don't scare us." And that's something to keep in mind as a real estate agent. If you're a real estate agent right now and you're worried about interest rates, don't be necessarily, because the only time I would ever get concerned is if houses cease to sell. If houses stop selling, then I'm getting concerned because there's no opportunity to go make money. And that's the big miss, where people get caught up in the media, they get caught up in the headlines, they get caught up in, oh my God, rates are so high, no one's going to buy, or this or that. Things that I look at all the time are how many houses sold last month. So in our MLS, I pulled some numbers this morning. There was 3,388 home sales last month. That means there was 3,388 opportunities to go sell a house. So if my goal is to sell 3 houses a month or 10 houses a month or 1 house a month, there's plenty of opportunity for me to hit my goal. I just need to focus on that and go find it and not use interest rates rising as a reason to be like, oh my God, the market's terrible now and nobody's buying. So a lot of real estate is just a mindset as well. And that's where, if you think about in 08, when the worst real estate market in the history of real estate, all right, so it was said, half our industry in St. Louis, 14,000 realtors in 07, I think cut to like nearly half by 2009 or 2010, because so many people said the market was terrible. But in 2007, 35,000 homes sold in a great market. In 2008, 30,000 homes sold. There were still 30,000 opportunities, but half our industry quit because people buy into headlines, that buy into the market's terrible. Oh my gosh. If you were an investor in 08, it was the best time to buy houses because everything was on sale. There was a fantastic opportunity. And that's how it is with this right now too. There are always opportunities. So don't just sit back and think, oh my gosh, the world's ending because rates are going up and no one's going to buy houses. There's still plenty of people buying houses. And as you can look at the data, there's thousands of opportunities every single month.
Exactly. And you need to look at it also from the standpoint of, what if rates continue to go up? What if rates go to 6, 7, 8%? And that's what the 30-year standard conventional, interest rate on a loan looks like. Well, then you look like a genius because you locked in at 5.5% because you're still ahead. And again, if inflation keeps going up, if it stays at 8%, like, chances are that we're going to see higher interest rates. And that's the key thing to remember, is that the interest rates are all based on numbers. Like, that's what everything is driven by. It's not just a random number that got picked out of a hat. So there are other factors that actually influence what our interest rates look like. And no matter what the interest rate is, just like the lady that you talked to that had a 12% interest rate at one point in time, they were still buying houses. They were still selling houses. The market didn't stop. And to your point too, it didn't cease. Nothing stopped. And that's the key thing to remember, is that the real estate market is always going to continue to turn no matter what the interest rate is, because people aren't buying typically their residential home, primary residence, as an investment. They're just not. They're buying it because they need a place to live. They want a place to live. They want a bigger house for their family. They want a better school district. Those aren't necessarily I need type of things. And the other thing I like to talk about too, if you have buyers that are, worried about interest rate, it's like, what is your alternative? Is your alternative to go and rent? Because guess what? As the interest rates go up, your landlords are having to pay more money on their properties as well too. So who do you think they're going to turn and pass that rent increase on to? Rent's up 10, 15, 20% in some areas. Yeah. And so that's a big jump as opposed to what we're looking at with the interest rates. And then not to mention too, if you're renting, not gaining any equity over time, you're also not gaining any appreciation over the prices of what the properties are selling for. So anybody that's been able to purchase already, and just even over the last short term, over the last 2 to 3 years, has seen significant price appreciation on their properties as well.
Yes, they have. And they're going to miss out on that because if properties continue to appreciate, they're missing out. The people that wanted to sit on the fence for the last 2 years and wait for the market to crash, they've missed out on 10, 15, 20% appreciation because they didn't buy it, and they missed out on the low interest rates. So that's when people are like, they say that now is not a good time. December was a great time. And if we continue to wait and sit on the fence, it could just progressively get worse for you from an interest rate perspective. So to your point, you have almost a guarantee that if the rates do get better, rather than waiting, buy now. If the rates do get better, you have a refinance opportunity. But if you don't buy now and you want to wait, what if rates go to 7%? What if they go to 8%? And to your point, you're renting, and then you're like, I had lease renewals came up, rent goes up. Rent's going to continue to get more expensive. So if you can still lock in at what's still historically a very good interest rate, 5-6%, even 6.5 or 7, it's not awful in the grand scheme of things. You should be taking advantage of that and finding that. And for the realtors out there, again, don't use this as an excuse not to go work. Like there's still
That's what it is.
Yeah, it really is. It's always a convenient excuse that people they'll find a reason for, oh my gosh, rates are high, no one's going to buy. Well, 3,388 people in our market bought last month. So far this month, I think 1,065 people have bought. So there's still tons of opportunity. You can go sell 2 houses out of the 1,065 that sold in the last 12 days.
Right. And you're not going to get interest rates as an objection behind it either. That's the thing, is that people that are out there looking right now, especially May, June, July, even August, like they're moving for a reason. They're moving to get into school districts. They're moving because it's the summertime and their kids are out of school. Like they're ready. So don't put that, oh, the interest rates are high in your mindset to think that it's literally a crutch for why you think people aren't going to want to buy a house, but you're putting that in your own mind. Exactly. And so to me, the interest rate is the interest rate. Houses still are going to sell. People still need to buy. It's more about the house, and it's more about that person's situation. And guess what? If they can still afford the monthly payment, that interest rate is largely irrelevant, because if and when the interest rates go down, they can refinance. And that's the key thing to remember, is that you're not locking in forever. Most people also move in 5 to 7 years, so they're going to have to do it all over again then too.
Well, exactly. So some key things to keep in mind here, as far as conversations you're having with your sellers would be, or your buyers, would be, if they say, well, I'm going to wait and see what rates do. What are we telling them? What we just said. We're talking about, you can refinance. If the rates do go down, you have the opportunity to refinance. What does it look like, Mr. or Mrs. Buyer, if rates continue to go up? Wouldn't you be happy you locked in today at 5.5% rather than potentially waiting and having to get a 7-8% interest rate? And to your point, Jeff, always looking at not the price of the house, but comfortable monthly payment. They do that with cars too. If you ever bought a car, you sit down with them and they say, what do you want your monthly payment to be? They don't say, how much do you want to spend on the purchase price of the car? It's monthly payment. The same thing can be done with housing as well. Where are you comfortable with your monthly payment? Because we oftentimes know people get approved for way more than they want to spend anyway. So you should be having that conversation in your buyer consultation as far as, where do you feel comfortable on a monthly payment? So we can figure out what price range we need to be looking at. But these are conversations you need to be having with your buyers now, not just saying, okay, well, let's just wait and see what happens. Let's just wait for the market to crash, because we've talked a lot about that over the last few weeks as well, that if you look at the market's going to crash. What's going to cause it? Like we've talked about, number of people in default at an all-time low. People in forbearance from COVID not paying their mortgages or catching up on their mortgages and getting out of forbearance. So the likelihood of them having to short sale or default, very low. Even people that do fall behind on their payments, they probably don't have to short sale because they have enough equity in their houses. So they can just list their house normally, get out of it. If they break even or even make money, even if they're behind on payments, can still get out of it. There's not a whole lot of signs other than some unforeseen thing that's going to cause a market crash like everyone's predicting. Like people just think that because it happened in 2008, it should just happen now every 10 years or 7 years. Market crashes don't happen every 5, 7, 10 years. Market corrections do happen. So if anything, we're more likely to see a market correction, meaning maybe some more inventory hits the market. Maybe we shift into not quite as strong of a seller's market. Because the other thing too, like in our market, we're at a 1-month supply of inventory. That means our inventory has to double for us to get to a 2-month supply, which is still an extreme seller's market. Anything under 5 months, 6 months is still a very strong seller's market. It could take us 5, 6, 7 years to get back to a balanced market without ever seeing a crash. There's statistics too on home builders. Home builders over the last decade built a record number, lower amount of homes than every decade previously. They got gun shy after 2008 and they quit building as much, which means that we're just having a hard time keeping up with an inventory right now for a lot of that reasons. One being home builders didn't build near the amount of homes that they did in all the decades previous. So the likelihood of us seeing a market crash, unless again, some unforeseen thing comes up like COVID, like the only time I was ever concerned about the real estate market was in March of 2020 when we had to stay home. Remember that? And I was concerned for about 2 weeks, not even, because I know there's always opportunity. And 2 weeks later, we started just crushing it. We were working from home. We shifted our focus. We're still making calls. We're still talking to people. People still wanted to get out and look at houses. And our numbers went through the roof. And we never looked back. But that was the only time with any real estate market that I was ever like had a little bit of doubt for a minute, just because we were stuck at home. And it was like, what does this look like? Are they going to shut down home sales? Are they going to say you can't go out and show houses? Are we forced to stay in our homes? It all worked out. And typically it always does work out. You just have to figure out how to adapt and work with things and not let headlines and media and Facebook and all of these other people that are going to paint negative pictures get into your mind, where you start just putting your head in the sand and want to stay home and be like, well, nothing's happening, so I just won't go to work today.
Yep, that would be the number one thing. Ignore the news. Ignore the news, ignore the stories, because it's all over dramatic. The reality too is, like, if these interest rates, okay, say the interest rates go back down, what's going to happen? The same exact thing that happened when they were at 3% and 4%, where we had massive amounts of people and the demand was still far outpacing the supply. Like, we just have to adapt to the market. If the interest rate goes back down to 3%, you're going to have people that are offering the $50,000 to $60,000 to $70,000 over for their houses. So you might as well lock in right now. You might have to go over 10 or 20,000, but because the interest rates are lower, you're not going up as much as we've seen when the interest rates were at 3%. The other thing too is, like, keep an eye on the market, like the stock market, keep an eye on the inflation rates. Like, those two external factors are going to impact builders too, because as the prices go up to build new construction, like, we just had a client that closed on new construction. They were under contract for over a year, but they gained, I believe it was like $10,000 worth of equity in their house just from like the build process of taking over a year. So the key is, had they never locked in to like actually go and build a new construction house, which right now most of the builders are probably, I would say 9 to 12 months out, at least that's ones that we're talking to, that's how far they are out. You might as well go get somebody under contract and have them start building the house, because you don't know what these prices are going to do. The prices, if they keep going up with inflation, real estate prices in general are still going to go up too. There's not going to be this massive crash. The whole crash concept, I don't get it, because especially from the last crash, it was all mortgage related.
Yes.
It was the fact that people could go and get loans without jobs, without income verification. Like, it was, hey, I make $100,000 and I maybe didn't have a job, or maybe I made 50, and I could get approved. And I could get approved for that. And that's the crazy thing, is that the adjustable rate mortgages too, what people were they weren't locking in at a specific rate. They might have a 3% rate to start, but it would go up 6, 7, 8, 9, 10%. And now they can't afford the house because of their monthly payment changing. That's the key thing to remember, is like, we haven't been locking in buyers with adjustable rate mortgages. They've been on fixed, which means from year 1 to year 30, that's going to stay the same. It's not going to go up. If they could afford it now, chances are very good that they can afford it next year and the year after that, and 5 years down the road after that too. So those are really key things to remember, is that this is not a 2008 scenario where, in my opinion, we're not going to see a crash anywhere near that.
I don't either. I think worst case, we get more inventory.
Yeah, literally.
It's just, more inventory.
Builders build faster and more builders build. But the key is too, if like inflation rate is 8%, your cost to build a house will be much higher.
It's going to keep going up. And just think too, there's still supply issues. You know, lumber went down a bit, but like, it's still hard for builders to get material. It's still, all of that stuff is still challenges. So we're going to be sitting in a lower inventory market, I have a feeling, for a while. So just kind of get used to this and figure out ways to adapt to it. Don't let the interest rate stop you from thinking that the market's going to stop. It's not. The real estate market's going to keep turning the way it always does for the last couple hundred years. And you just have to keep working. Like, that's the best thing. To your point, Geoff, don't pay attention to the news. Don't buy into the headlines. Look at the data. Are homes still selling? Yes. Even if home sales are down a little bit over last month or over last year at this time, is there still opportunity for you to hit your goal? And that's what I always focus on. If my goal is to sell 3 houses a month or 5 houses a month, is there enough opportunity out there to go sell it? Well, if only 5 homes sell in the MLS, that might be a challenge. But if 1,500 homes sell, or 3,000 homes sell, or 4,000 homes sell, there's enough of an opportunity to go sell 5 houses in a month. There's enough to go sell 36 homes in a year. There's enough as a team to go sell 300 homes in a year. So those are the things you need to focus on, not the negative, not the doom and gloom. Oh my gosh, this is terrible. Is there opportunity for me to hit my goal? And if there is, you need to increase your activity. You may have to do more right now to find these clients. You might have to make more calls, talk to more people, work a little bit harder, and it's all possible. Don't just buy into the fact that rates are up, so nothing's happening.
Exactly. Houses sell year round, so never quit.
Exactly. That's what a lot of people do. They just kind of buy into the negative side and say, well, not for me. I'm going to give up. Don't do that. Stuff's always happening. So with conversations, I hope that helps a little bit when having conversations with your buyers, as far as educating them on the fact that they can refinance if rates do go down, asking them, what does it look like, Mr. Buyer? What does it look like if rates continue to rise? Wouldn't you be happy we locked in today at 5.5%? Exactly. And you got the benefit too of refinancing if rates do go down. Let's take advantage of what we have in front of us right now, get you into a home so we can get you the best possible price and get you into that home for your family. That's it.
At the end of the day, that's all is what it's all about, is what's best for their family, what's best for their scenario, and can they afford the monthly payment?
Exactly. Absolutely. Hope that helps. Anything else to add, Jeff, before we wrap up?
Go get your buyers under contract now. You know, you think that the competition was bad when we had 3% interest rates. Like, competition isn't nearly as bad as that was now. So if you are a buyer, go get them under contract. Don't let the interest rates affect them, because if the interest rates go back down, all that competition comes back. So
Yeah.
Buy now, buy later. Just go do it now.
Exactly. And one last point too. If your buyer got approved, say in December, November, something like that, they should be talking to their lender, getting updated pre-approvals, because their numbers could change. As we talked about, every 1% interest rate rises, they could lose potentially 10% purchasing power. So make sure they're talking to their lender, get them updated pre-approval so they see where their payments at, what their affordability is at. So that way you're not showing them homes that might be out of their price range now. It's a good reason to just keep in touch with their clients, have them talk to the lender, get that updated pre-approval. To your point, get them out there, keep them out there, get them a house, and they'll be happy.
That's right.
All right. Thanks, Jeff, for being on today. We will see you guys all next week. Have a good one.
All right. Thanks. See ya.